Picture a world where someone without any credit history, no credit card, no loan, no formal banking record, can walk into a lender, have their creditworthiness assessed in seconds, and walk out with access to a loan. Now imagine that the decision isn't made by a rule-based FICO algorithm from the 1990s, but by an AI model analyzing hundreds of data points, transactional flows, digital footprints, mobile phone usage, even social signals, with consent. This isn't speculative. It's happening now. But with this power comes massive responsibility. What happens when decisions affecting lives are made by machines? In this video, we'll unpack the technology behind AI credit scoring, explore how it's reshaping risk and inclusion, dive into the real trade-offs and ethics, and synthesize what this means for the future of finance. Welcome to the Tech Radar. Let's get started. Why finance needs a reinvention of credit scoring. For decades, lending has relied on traditional credit scoring models: income, employment tenure, debt-to-income ratio, credit history. But these models exclude large segments of global population: the unbanked, the thin file borrowers, gig economy workers. A recent paper finds that AI-enabled credit scoring improves approval rates and reduces default risk for underserved populations. According to McKinsey, credit risk organizations are already adopting generative AI technologies. A year on, Gen AI is making its mark in multiple industries, including credit risk. What's changed? 3 major drivers: alternative data explosion, mobile phone usage, utilities, rental payments, even behavioral data. Compute and model advancement. ML and deep learning can handle complex nonlinear relationships. Regulatory pressure and inclusion goals. Regulators and fintechs are being pressured to broaden access. Hence, AI-driven scoring is no longer optional. It's a strategic necessity for lenders who want to grow responsibly. How AI credit scoring works, a technical deep dive. Traditional models consider 20-30 variables. AI models ingest hundreds to thousands of features. For example, transaction frequency, mobile top-ups, utility payments, device metadata, geolocation, even social signals. A S&P Global report states, S&P Global is quoted remarking on this topic: AI leverages machine learning, credit scoring, and scaling to thousands of counterparties, using alternative data. Most lenders use ensemble methods: gradient boosting, random forests, deep neural networks. One case study found accuracy moving from 0.69 to 0.83 using a random forest model for SMEs. Instead of a simple approve, decline, AI produces probability distributions: probability of default, early delinquency, lifetime value. These scores allow modular decisioning, adjust interest rate, collateral requirements, credit limits in real time. With regulations such as the EU's AI Act classifying credit scoring as high risk, lenders must ensure transparency. One study on XAI says, this model achieves state-of-the-art performance, enhanced with a 360-degree explanation framework. A quote from Archive. Hence, AI scoring isn't just about accuracy, it must be interpretable, fair, auditable, and robust. Real-world use case: using AI for credit scoring and financial inclusion. Let's walk through a fintech case. Company Upstart Holdings partners with banks to lend using non-traditional variables: education, job history, behavioral data, rather than purely FICO. Scenario: borrower A, rideshare driver, no traditional credit history, strong digital payments record. Traditional model: decline or high interest. AI model: variables show consistent payment behavior, device metadata, rental payment track record, approve with moderate risk. Result: borrower obtains credit, builds history, benefits from inclusive financing. Lenders capture a new segment of borrowers. Default rates remain stable or even improve because model captures hidden signals. For example, studies find improved approval plus lower default using AI for underserved groups. Signal strength. AI finds that consistent mobile top-ups correlate with repayment behavior. Feature interactions. High job switch rate plus late payments plus low device age. Risk flagged. And real-time underwriting. Loan decision in seconds, not days. Dynamic portfolio management. The same borrower is rescored continuously. If their risk falls, offers improve. Trade-offs and risks. What keeps executives awake at night? Despite broader data, bias can creep in. For example, if certain demographic groups have less digital footprint, the model might unfairly penalize them. One article notes, despite its potential, AI adoption entails risks including data privacy, algorithmic bias, and the digital divide, says ResearchGate. Deep models can lack interpretability. Regulators say you must explain decisions, e.g., why was my loan declined? XI frameworks are evolving, but not universal. Explainable AI for interpretable credit scoring. A quote from Arxiv. More data equals greater risk. Using mobile or social signals raises consent and privacy issues. Are borrowers aware how their data is used? If many lenders deploy similar AI models, correlation risk grows. If one fails, systemic risk rises. The BIS paper observes, AI investments help banks mitigate credit supply cycles. A quote from the Bank for International Settlements. AI should widen access, but if underserved groups don't have digital footprints, they might still be excluded. Some models show smaller improvements for missing weak signals, says SSRN. What AI credit scoring means for the future of finance. Putting it all together, AI credit scoring is not just a better model, it represents a structural shift in finance. We move from static scores, FICO, to dynamic signals, continuous data streams, real-time updates, adaptive limits. With wider data, more people can get access to credit. Lenders can expand responsibly. This increases economic growth and inclusion, but only if ethical frameworks are in place. Underwriting, usawawal, seconds, not days. Algorithmic decisions plus human oversight. Finance as a service becomes embedded. Your digital wallet, social app, rideshare app could offer financing seamlessly. Lenders who adopt AI well will have competitive advantage. Better risk-return profiles, faster decisioning, lower cost. Others risk margin erosion or exclusion. With power comes governance. The institutions that embed fairness, transparency, model governance, and explainability will be the winners. Trust will become a competitive moat. Well, if you're a borrower, you should ask, what data is being used to assess me? How transparent is the process? If you're an investor, you should watch firms deploying AI credit scoring. They may have higher growth, but also governance risks. If you're a creator or tech professional, you should explore how AI models are built, data, features, interpretability, and consider how you can contribute or watch from the sidelines. AI-driven credit scoring is more than a fintech trend. It's one of the foundational shifts reshaping finance from the ground up. It rewrites who gets access, how decisions are made, and how risk is managed. But it also challenges us to ask tougher questions. Who controls the models? Who governs the data? And what happens when a machine declines a loan? If you found this deep dive into AI credit scoring as fascinating as I did, hit that like button, comment below with your view. Would you trust an AI with your loan decision? And would you want to know why it accepted or declined? And if you're not yet subscribed to the Tech Radar, do it now, because every week we've got another futuristic deep dive waiting just for you. Thanks for watching. See you in the next video.